Hey everyone, and welcome. So, you're starting your career, maybe looking at jobs in tech, and you keep hearing this term, stock options. They can be an amazing part of your compensation, but let's be honest, the tax stuff can feel, well, super confusing. In this explainer, we're going to clear all that fog away and make it simple. People often wonder about stock options. Are they this golden handcuff that locks you in with a giant, confusing tax bill? Or are they a real, honest-to-goodness, golden opportunity? Well, the answer really, truly depends on how well you understand the rules. And that's exactly what we're going to build today. All right, here's our game plan. First, we're going to decode the lingo so we're all speaking the same language. Then, we'll walk through the three most important dates in the life of a stock option. After that, we dive into the big one, the different rules for public versus private companies. And we'll wrap it all up with what this means for your bank account. Okay, first things first, we have to get the vocabulary down. I know, it's not the most exciting part, but trust me, getting these few terms right is the foundation for everything else we're going to talk about. So what even is a stock option? The easiest way to think about it is like a coupon. It gives you the right, but, and this is important, not the obligation, to buy company stock at a locked-in price. We call this the option price. So no matter how high the stock goes, your price to buy is fixed. Pretty cool, right? Next up is fair market value, or just FMV. This is just a fancy way of saying the current, real-time price of the stock on the market. The whole point, the reason you get excited about options, is the gap between your low, locked-in option price and this, hopefully, much, much higher FMV. That gap is where the value is. And finally, this one is a really big deal for what we're discussing, a CCPC. That stands for Canadian Controlled Private Corporation. For our chat today, just think of this as a Canadian startup or any private company. You're about to see that the tax rules for employees at a CCPC are wildly different from a big public company. Every stock option has its own little life story, a journey with three super important moments. Understanding these dates is everything when it comes to figuring out when and how you owe tax. So it all starts with the grant date. That's simple. It's the day the company says, here you go, you've earned these options. Then you have the exercise date. This is the day you decide to cash in your coupon and actually buy the shares at your special price. And last, there's the disposition date. That's the day you sell those shares and hopefully make a nice profit. Let's put that on a timeline. On the grant date, absolutely nothing happens with taxes. It's just a piece of paper at this point. The exercise date, this is a potential tax event. And the disposition date, that's a definite tax event. That little word potential is the whole reason we're having this conversation. To make this all feel a bit more real, let's invent an employee. Let's call her Anna. So Anna's company grants her 1,000 stock options, and her special locked-in price, her option price, is $10 a share. We're going to see how her tax situation plays out based on where she works. Okay, this is it. We've arrived at the absolute core of this explanator. The difference between a public company and a private CCPC isn't just some boring accounting detail. It has a massive, massive impact on your wallet. Okay, so let's imagine Anna works at a big public company. Grant date, still no tax. But look at that exercise date. The second she buys those shares, the government says, aha, that paper profit you just made is employment income, and you have to pay tax on it in that same year. Let's run the numbers. Let's say when Anna decides to exercise, the stock is trading on the market for a fair market value of $30 a share. The math for her taxable benefit is pretty straightforward. You take the market price, subtract her special option price, and multiply by her number of shares. So that's $30 minus her $10 price, which is a $20 gain per share, times her 1,000 shares. And bam, just like that, Anna has $20,000 of taxable employment income. Now here's the kicker. She has to pay income tax on that $20,000 this year, even if she hasn't sold a single share. She might not actually have the cash to pay that tax bill, which is a huge problem. But what if Anna works for a startup, a CCPC? Now let's look at the same chart. Check out the exercise date. The tax consequence? Nothing. Zero. The tax is deferred until she actually sells the shares. Let's put this side by side, because this is the whole shebang. At a public company, you pay tax when you buy. At a qualified private company, a CCPC, you only pay tax when you sell. This means you only get a tax bill when you actually have cash in your hand from the sale to pay for it. I mean, what a game changer. And that really gets to the heart of it. For anyone working at a startup, this isn't just some nice little perk. It is the whole game. It completely flips the script on stock options and makes them so much less risky and so much more accessible. Okay, we've covered a ton of ground. Let's bring it all home and boil it down to the absolute must-know points that you should take away from all of this. Okay, takeaway number one, the rules are completely different. Public companies, you're taxed when you exercise. CCPCs, that tax gets pushed to when you sell. Also remember this really great bonus. There's often a 50% stock option deduction on that employment benefit, which is amazing. It basically cuts that part of the tax bill in half. And finally, any extra profit you make after you've exercised is a capital gain, which also gets favorable tax treatment. So next time you're looking at a job offer and it's got stock options, you're now armed with the right knowledge. You know the most important question to ask isn't just how many options do I get, it's how are they going to be taxed? Because knowing the difference between a CCPC plan and a public one could literally change your financial future.